Hello and welcome. You're watching Newsline. We're bringing you top stories from the world of business policy and economy. First up, India's economy grew by 6.1% in the fourth quarter of 22-23, pushing the annual growth rate to 7.2% in the fiscal year. Also, the Securities and Exchange Board of India has now proposed to tighten disclosure requirements for foreign portfolio investors to prevent misuse of the overseas investment routes and curb public shareholding norm violations. This in the aftermath of Adani Group and the allegations that were levelled by Hindenburg. We're also tracking Go First. Debt-strapped Go First has urged DGCA not to suspend or cancel airlines' air operators permit, which is AOP, as it will lead to airlines' collapse in the near term. And get ready to pay more for your electric scooters from 1st of June this year, as the government will significantly reduce subsidy it offers on electric two-wheelers to customers under its FAME 2 scheme. All of that and more on this bulletin. With me in the studio is Karthik. Good morning, Karthik.
Good morning, Shweta.
Great news coming in as far as growth rate is concerned. Better than expected, not just for the fourth quarter of the fiscal year gone by, but also the entire year. We discussed it last evening. Some very interesting numbers there.
Interesting numbers indeed, but I think the trend is even more interesting. You know, you had a situation back in February, March when World Bank and IMF were pegging India's growth to be in the range of 6.2 to 6.4%. You had just last week a Reuters poll with 56 economists pegging India's Q4 growth at 5%. And look at the numbers that came out. A 5% global economists poll by Reuters translates to 6.1%. And that sort of surge in the Q4 numbers have taken the GDP up from 7% estimated to 7.2% for the whole financial year. Mm-hmm. So, I think numbers are great. Obviously, what is important is that this growth momentum needs to continue.
Right.
It's easy to fall back on your laurels and assume that, hey, you know, we've done better than the rest of the world. We are among the fastest growing economies in the world, the fastest growing major economy in the world, at a time when, you know, the global economies, including those of Germany, Europe's biggest economy, has seen recession. There's degrowth, negative growth. Here we are looking at a good 7.2% annual GDP growth. That, I think, is great news, but it's very important for this growth momentum to continue. And there are going to be certain advantages and a few challenges in sustaining this growth momentum for FY24. I think the biggest challenge comes on the back of monsoon. Now, the monsoon is estimated to be normal, but I mean, let's face it, we have seen unseasonal rainfall in North India and unprecedented low temperatures not seen in the last 3 decades almost.
Absolutely.
It was the coldest May in 36 years, and we've seen sporadic rainfalls, downpours literally in and around Delhi, NCR, Punjab, Haryana. So it is bound to play havoc when it comes to agriculture output. Now, add to that an El Nino event getting triggered, crop could go for a toss completely. So what this does, this is going to add inflationary pressure. Now, let's put agriculture also in context. We had stopped exporting wheat in the aftermath of the Russia-Ukraine war. We knew that inflation, supply chain constraints are going to hit us. So we have a bumper produce of last year, a lot of it still stashed away in warehouses, which can be used to contain inflation, at least in the monsoon months and the immediate sowing season that ends around October. But what happens when the Kharif crop begins to sort of get sowed? So overall, you will be able to safeguard yourself for maybe about 2 quarters or so. And thereafter, you will see the pressure of food price increase really hit consumers. But the good news is that there is stability expected around September, October again in terms of oil prices. So oil prices hopefully should level out, and that should balance the agriculture output and import bill on oil.
Right.
To a point that we should be able to sustain the growth momentum. Will it be at par with or greater than what we have seen this year? We don't know. Remember, it's also an election year. So, you know, inflation will have to be tamed. Q on Q growth will have to be projected better than estimated, better than expected. So how all of this pans out and balances itself out is something we need to see.
It's important to point out, we're talking about numbers from January to March, where the rainfall was as expected, in line with the expectations. So of course, the numbers are speaking for themselves. But the trend that you've mentioned specifically started from the month of April,
That's right,
March, and thereon.
And the monsoon season kicks in now.
And the monsoon season
right?
kicks in now in late June, early July, which means we will see impact of unseasonal rainfall starting the next
right.
quarter when
That's
the numbers start
OND,
coming in.
Q3, October, November,
correct.
December.
So the first sort of quarter of the next financial year, which started 1st of April. So we'll see numbers there. Whether agriculture sector overall has taken a hit or not, we don't know just as yet. But GVA for the quarter gone by, and in fact overall for financial year 23 in agriculture, forestry, fishing, saw a robust growth of 4%, which means essentially, and we're talking about a largely unorganized sector here, and this was a large debate yesterday, because these numbers, as Professor Arun Kumar, who was on the panel with us yesterday, said, reflects growth in the organized sector, in organized India. A large chunk of India is still relatively unorganized. The only sector that perhaps tracks the development growth in unorganized sector is agriculture, but that is also picking up, which essentially means that it's not just the core industrial output that is going up, the organized sector that is seeing some sort of growth momentum, but also unorganized sector at this point in time.
Absolutely right. So if you look at the full financial year GVA, it came at 7%, and that is also an excellent number. You don't see so much value addition in an economy which, like you said, rests to a large degree in the unorganized sector. And GVA captures only the value added on raw material imported and therefore processed and shipped out or domestically sold in the country. So you're right. I think it is going to be important to see how the unorganized sector plays out in this year. Of course, we had the advantage last year of, let's say, a very, very robust quarter-on-quarter growth between Q4 of FY22 and Q1 of FY23. We ended Q4 at about 4% growth. So the immediate aftermath of that, Q1 of 23, which is April, May, June last year, came at a resounding 13% growth. So that 13% gave us a very good margin to sort of average out our remaining subsequent quarters, which, barring Q4, which grew at about 6.2%, the rest of them were in the range of 5 to 6% only. So we saw that great fillip coming from between the Q-on-Q growth between Q4 of FY22 and Q1 of FY23. And yeah, the gross value added at 7% overall is, of course, good news, because this is the value addition you are doing as an economy. And this is the value addition that that is generating employment, that is keeping factories running and firing on all cylinders, and that is propelling the kind of consumption that you see in the economy. But having said that, I think consumption is still something that really has to be worked upon.
Absolutely. Manufacturing consumption still remain laggards.
Exactly. So in manufacturing, again, what really saw us through last year was the government not tightening its purse strings. We saw what the government started, the supply side reforms, which started during the pandemic, continued the year after. The public spending continued from the government side all of last year as well. But the private sector is yet to show their animal spirits, as it is referred to, and make those robust investments.
Still
and those
a sleeping elephant there.
That's right, and which is what Rakesh said, I think, yesterday morning, that there is agility on the side of the government, but bureaucracy on the side of corporate India. Now, I think that the former needs to continue, the latter needs to pivot. So if that happens, you will see better employment. Better employment will obviously increase private consumption, which is right now marred because of inflation as well. But again, inflation data comes a month too late. So the tightening that RBI has done successively, barring only the last MPC, where again the policy was paused and it wasn't really a pivot, as the governor had said. So for private consumption to pick up, you need employment generation, and employment generation will happen in the private sector, and it will happen in the private sector only if there are enough investments made by the private sector to set up new factories, to set up new offices, to expand their businesses. And this becomes a further more pronounced opportunity, because we have seen FDI inflows dwindle. We have seen startup valuations getting cut. So overall, when you look at the economic environment, you really need the top 50 companies, the nifty 50 stocks, so to say, to really go on a rampage and make investments. And there are enough and more schemes, PLI for example, right? You need to, so manufacturing is incentivized. We know that there is friction between China and India, and China and US, and pretty much, you know, the entire China divide with the rest of the world barring Russia. So we need to exploit that to our advantage now. And you know, just getting 2 Apple stores to open in the country means nothing. It has to go well beyond that. It has to result in real investments, real employment generation, and that is going to offset the inflationary restriction in demand uptake.
You know, borrowing from the wisdom of our panelists yesterday, a sustained argument was that private companies are still not seeing much value in investing. They may not be getting returns that they were expecting, or maybe just holding on to the money they have until, you know, larger recessionary forces passes by. So the overall idea that you can only expect private companies to invest when they see value being added and they're getting the desired returns. What exactly do you think, in your opinion, is holding them back, and what can government do to make them spend more?
So, a couple of things which are holding them back. Number one, of course, supply chains are marred the world over. So, does it make sense to invest right now when you may or may not find an immediate offtake of your production elsewhere in the world, right? Number two, of course, inflation. Consumption is low. If the consumption had kept pace with the kind of at least government spending that we have seen, there would have been more incentive for the private sector to produce more, which could be sold in the market and bought in the market. It can still be sold, it may not be bought. So you want whatever you produce to be bought. But I think most importantly, the private sector is also on tenterhooks right now, because they know as well as we know that this is election year. Where do you want to buy land? Do you want to enter a particular state and then, you know, the results not coming through as expected owing the general elections next year? So I think as soon as the government is formed, almost exactly a year from now, if things go as planned, you will see an immediate pickup in private sector expenditure. Till then, I think they're going to be on tenterhooks. They're going to take it slow, wait and watch. You know, it's not that they are filing for insolvency or as if their profitability is not bloating. Yeah, but making those capital investments, I think, is largely, you look at the entire pestle environment, right? There's a political environment, there's an economic environment. You've got to look at all of that and then take a very calculated cost on, should you invest today, or would you rather invest in a government bond, or, you know, in a corporate debt product or something, safer haven, maybe US Treasury for that matter, and hold on to your investments for now. Unleash it when you know there is a sustained surety of political stability for the next 5 years.
Right. And, you know, that brings me to the point of government spending, government doing its bit, because we've been making that argument that government has earmarked a certain money for capex. But yesterday, in the discussion that we had at 6 p.m. after the numbers came out, Professor Arun Kumar said something very interesting. He said, government is spending largely on capital-driven markets. It's not spending on labor force. It's not spending on labor-driven markets, which essentially means that we're not seeing much employment being generated. It's very cautious in the way it's spending. So it's not really spending for the last man standing out there, but essentially spending on high-value projects like railways, infrastructure, road development. So that doesn't really translate into labor force participation getting bigger, or laborers getting, you know, their due sense of employment, and then perhaps becoming a part of a formalized economy. Do you agree with that argument?
See, there are two ways to look at it, Shweta. You know, I mean, of course, Professor Arun Kumar, in his wisdom, and obviously given his body of work, you know, it's difficult to challenge his mindset, but and his qualifications. But what I feel is there are two ways to look at it, right? What does the government really want to do? What is the real value creation that the government wants to do? Value creation will happen if there are capital expenses incurred, if there is infrastructure built. because this is going to have a multiplier impact on economic growth for years to come, right? As opposed to, again, if you look at Adam Keynes, the Keynesian economics, which pretty much states that it's best to employ people, even if that means that get them to dig trenches and fill them up, and dig them again and fill them up. So the government has to spend. Would you spend on making the labor force do rudimentary work, redundant work, which will feed them immediately, but will not sustain them in the long run? Or would you rather spend the same money building assets which will have a multiplier impact on the economy? So, not to discount Professor Arun Kumar's wisdom and experience, but I feel I tend to side for a change with the government and with the measures that the government is continuing to take. See, even in terms of safeguarding the labor force, the unorganized economy, you have incentivized DBT, free ration. You've done that till as long as it was sustainable, and you continue to do it even today.
I think what he was specifically referring to was Manrega, where government has literally cut down its spending by, what I'm reading is 32%, which is significant. Essentially, and we're talking about a large chunk of people who don't have jobs, who are looking for a minimum guarantee of employment, and if not employment, money in lieu of that employment.
But tell me something, Shweta, you know, if you're building highways, if you're building bridges, if you're building ports, if you're investing in any sort of capital expenditure,
you're anyway employing.
You're employing them.
I agree.
Right.
Yes.
So the project cost of building a highway in any case entails labor cost. So instead of paying the labor directly to do something that may not add enough value to the economy, you are actually adding value to the economy and indirectly employing them anyway.
That is correct. All right. I think this is an interesting discussion. We ought to have Professor Arun Kumar back sometime with us to perhaps explain and be able to speak for himself, since he's not here today. But interesting discussion. Before I let you go on this one, I have one final, sort of clarification. A lot of media outlets, we're looking at papers today, have reported that although growth numbers are better than estimates, last year the growth was at 9.1%, so it's lower than last year. What would you attribute that to? I mean, I understand there was low economic output overall.
K-shaped recovery. It was simple, right? You had a COVID-like once in a lifetime, once in a century event, which had marred economies the world over, including India's. So when you look at FY21, we were in the thick of COVID. FY22 started when again you were in the midst of the second wave, the Delta wave. So economic activity was low. You had a great small base effect on your growth in FY23, right, in FY22. So you had a situation where FY21, which is technically March 2020 is when COVID hit the world, right? And from then till the entire financial year that ended, there was practically next to nil economic activity. You had seen a decline of 23, 24% in the GDP growth. So it was a negative 23% to a positive 9% is basically coming back to normalcy.
Right.
And not even that actually. You didn't even repair the losses that you had made or the degrowth that you had made in the previous year. So I think 9.1%, great headline number, but it came on the back of negative economic growth. Whereas here
in the preceding financial year.
Here you're talking about a 7% growth over that 9% growth.
That is correct. Right. So numbers there speaking for themselves. Good news, as I said, for the government. Government, of course, is going to mint that. This is just a year ahead of elections, and elections, of course, in states as well as national elections due next year. We will, of course, have to wait and watch out for what that means for the central government. Remember, this is the growth numbers for financial year 23. This year, upcoming year, is going to be all the more challenging, and government, of course, cannot sit back and rest on these numbers. It will, of course, have to prove itself over the course of one next coming year. Shifting to another interesting story that we are tracking at this point, and we've been talking about two-wheelers, and I want to come to that first because FAME scheme has been under question for a very long time, whether government is going to sustain and continue its effort to spur two-wheeler electric growth in India, will help manufacturers and will keep giving them some sort of money in lieu of, subsidizing two-wheelers. But there's been a lot of controversy, there's been a lot of back and forth, industry obviously hoping that FAME scheme will continue. But from what we see at the moment is that FAME 2 will gradually fade out, which means that cost of electric two-wheelers is going to go up immediately, in fact, as soon as starting June 1st.
That's right. So, I mean, the FAME subsidy was started. What is FAME? Faster adoption of
and manufacturing
of electric vehicles, hybrid and electric vehicles, right? So, what did the government really want to do through this policy? The government wanted to get consumers to buy electric vehicles, but electric vehicles, as we know, are expensive. ICE engines are cheaper because you've had decades of manufacturing to offset the fixed cost on the technology. Here, you're looking at a new technology which requires tremendous investments on manufacturing, setting up of new plants, setting up of that technology, transfer of technology, importing batteries, the works, right? So, the government wanted to incentivize electric vehicles, not just electric scooters, electric vehicles as a whole, three-wheelers and four-wheelers as well. So, there was an outlay of 10,000 crores which was kept aside on incentivizing adoption of electric vehicles through FAME. Now, of course, the industry did not end up using all of it. There was some leftover money from that. And the industry had also run into other challenges where there was some misuse, alleged misuse of the FAME subsidy as well. So, what manufacturers were doing was they were selling the charger separately, they were selling the software separately, and then the government came down heavily on them and said, hey, you know, don't BS around, this has to literally be part of the same unit that you sell. So, cut to the chase, now what happens is the government said, we are not going to subsidize electric vehicles by electric two-wheelers by 60,000 rupees, right? 50,000 or 60,000, if I'm not mistaken, was the maximum subsidy two-wheeler manufacturers could avail, and pass that on directly to the consumer. So, a scooter that would be priced at 1,50,000 rupees would be available for 90,000 rupees. Right. Now, the government is saying there has to be a gradual withdrawal of this subsidy. A, because you're running out of the corpus that had been allocated. B, you saw industry also misuse it. And C, the organic shift has to happen. It cannot continuously be incentivized. Now, last year we saw a record 1 million electric scooters being sold. Nobody had expected that. But we had 1 million electric vehicles sold last year, and basis that, the projection this year was about 2.3 million scooters.
Right.
Now, with this subsidy reduced from 60,000 to 22,500 rupees per scooter, means scooters are going to get expensive by almost 40,000 rupees. So, the same 1,50,000 scooter which was available for 90,000 rupees up until now, till yesterday in fact, from today, that scooter will be available for a little short of 1,30,000 rupees. So, from 90,000 to about 1,28,000 rupees, it's a good markup, which is going to pinch the end user, the buyer of an electric scooter.
Absolutely.
So, that is obviously bad news, but then, and industry is also, so there are both points of view again in the industry. Some people believe that the 2.3 million expected sale for this year, number of units sold for this year, could be halved to a 1.2 million, which will hardly be any growth over last year. But some people also feel that this is a gradual withdrawal of subsidies, which is going to prime the market to purchase these products at the price at which they are manufactured, with a little delta, right? But I think what is most critical in this entire story is our dependence on China for procuring batteries. And that game has to shift. So, once we are able to produce these lithium-ion batteries in India, or find another economy, another country which is able to produce this and sell it to us at a more advantageous cost, a better negotiation can then ensue. And overall, you can see prices over time with economies of scale, with cost of raw material going down, and with the technology cost getting amortized over more number of units sold, you will see stabilization in prices, right? No, it's a new technology. A new iPhone is priced higher.
Absolutely.
A new model arrives, this becomes lower, right? So, it's pretty much the same logic. Over time, you will see, barring inflationary expenses, you will see that prices are going to stabilize, and you can't subsidize buying forever. At some point, market forces will have to play.
Absolutely. And companies are, of course, bracing for an initial halt in the sales figure. They are expecting that there's going to be some breaks there to the number of vehicles that have been sold over time. People are not going to buy with the same pace. Ola Electric, from what we are understanding and what is being reported in newspapers, is going to raise prices by at least 15,000 rupees. Ather, which is selling electric vehicles, two-wheelers in large numbers, is saying it is going to reduce subsidy. So the average vehicle that you buy from Ather is going to cost you 32,500 rupees more. And Hero Electronics hasn't really come on record. So Hero Electrics is saying we're going to keep our prices unchanged for now. And maximum subsidies, which was capped at 40% earlier, is going to come down to as much as 15%. So right. that is a massive decline there.
That's what 60,000 subsidy is now only 22,500. So
right. And so if you are hoping to buy an electric two-wheeler, you should do that before 1st of June.
Well, too late.
Oh, too late. It is 1st of June. Absolutely. Right. So starting today, there's going to be a gradual increase. There is no immediate increase in prices. You can still go and still check prices, compare them to what they were being sold at as of yesterday, and see if you can get a better two-wheeler electric deal. We're going to move on now. The Securities and Exchange Board of India, SEBI, has now proposed to tighten disclosure requirements for foreign portfolio investors. Now, this has come largely on the back of the Adani story that we've been discussing. There was, and we discussed that report that came out of Supreme Court appointed panel on Adani Hindenburg, where they said, and I quote, that SEBI is in a chicken and egg situation. They changed norms on the disclosures of the last person holding stake, opaque structures of FPI. Now SEBI says we're going to go back to what it was initially. If an FPI has more than 50% investment in a single firm, you have to declare who owns the money, what is the structure like.
Correct. So 2 points here. A, not a single entity or a single firm, but a single group. Right. So if we were to look at the events that unfolded with Hindenburg Research and Adani Group, you look at Adani Group as a whole and not every single entity within the Adani Group. That number one. So 50% holding by any FPI in any single group, or 25,000 crores of investment in a single entity, right? Okay. So the FPI may be valued or must have investments much higher than, let's say 1 lakh crores, for example, in which case the 50% norm could be breached by having the 25,000 crore and upwards investment. So so I think what SEBI intends to do here is pretty much safeguard any potential misallocation of funds by an entity taking the FPO route to breach the MPS 25% minimum public shareholding value. Now, what happens is retail participation or FPI participation or holding, promoters' own stake in the group is all listed. But if the promoter were to invest back in his company using the FPI route, and if the FPI has got these opaque structures where you can't pin it down to who the last person is, who has parked his or her money in that FPI, you've pretty much circumvented the whole process.
Absolutely.
Right. So I think SEBI has realized that. Now, I'm not sure if it is fair to say that it is being done only to tighten the noose on Adani. No, I think the Adani Hindenburg saga has been a good case study. It's been a good case study and a wake-up call for SEBI to realize that, hey, MPS rules could be flouted, and some people could sort of circumvent the process by taking the FPI route and sort of just fogging the system without the system being able to identify them as promoters or investors in a particular company. So I think it comes on the back of that, definitely, but specifically to tighten the noose, not really on, I think, 1 or 2 or 5 entities. This is largely to create a more robust ecosystem where there is transparency and not opacity. Absolutely. There is accountability and there is traceability. You should be able to pinpoint exactly who the investor is who may want to otherwise not disclose.
For the layperson who's listening to us right now, who really doesn't understand what this means, I want to just break it down to begin with, and help us understand what is minimum public shareholding structure like, what are the allegations on Adani, and what does this mean for companies here on?
Okay, so let's take it one by one. Minimum public shareholding, SEBI mandates that any publicly listed company, any company which is traded on the stock exchanges, needs to have at least 25% of the shares allocated to the public for free trade, free purchase and sale, right? So public can exchange can trade those shares, and those shares must be at least 25% of the total shareholding within a company, right? So that is MPS. What really went down with Adani Hindenburg saga was that Hindenburg Research had alleged that Adani Group had succumbed to short selling, which means that it had invested directly or indirectly into its own stock for a short period of time, knowing very well that the prices are going to surge, and thereafter, as soon as the prices surge,
jack up the price
got jacked up. You sold the shares that you had invested for the short term, which is called, and you sold, so that is called short selling. So you short sold your investments and made an immediate profit. Now, all of that is yet to be proven. SEBI is doing its own independent investigation into the matter. A Supreme Court appointed panel is looking at whether there was any laxity on part of the Security Exchange Boards of India, SEBI, and in seeing that this minimum public shareholding was not adhered to, and in case there is any incident of what Hindenburg Research has alleged. But that investigation by SEBI is underway, and the results of that, or some progress on that, is expected to come out on the 14th of August. So until then, this is where we are. So what in its preliminary report, what SEBI claimed to state was that it had hit a sort of a wall in trying to identify who the investors are, and therein, because of these opaque structures, not knowing FPIs are investing on behalf of whom into which stock, it was unable to identify who the real investor or the short seller, as the case may be, was.
So SEBI there tightening news on not just one company here, not just on Adani, but overall on publicly listed companies to declare who their investors are, and so as to not have an opaque structure. And we know how, and perhaps the market regulator and people in general, public in general, know who is the last person gaining out of an investment into a publicly listed company. And finally, I think an important story before we wrap up is on Go First. We are talking about revival of Go First. We don't know, there is no timeline just as yet. DGCA had given time to Go First to come up with a plan to inform the regulator as to when it's going to go back to skies, but it has asked for more time. It now fears that their operating license that allows them to fly will be suspended or may not be suspended, but it has requested the regulator to look into its application, give it more time to go back to skies.
So, Shweta, it's been almost exactly a month. Tomorrow will be exactly a month since 2nd May, when Go First volunteered insolvency, took the NCLT route, right? And it came on the back of faulty engines, which led to a financial crunch in the airline. So the CEO, Kaushik Khona, has written to DGCA and has gone on record to state that this is a pure play debt-based issue. It is not that the management is incapable of running an airline. Right. Okay. So now it fears that there is going to be suspension.
All right, Karthik, we're going to come back to that. But Amit Shah is speaking at the moment. Let's cut to that.